Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today we're diving into the annual report of FOXO Technologies, ticker symbol FOXO. And let me tell you, this one's a roller coaster. It's like watching a company try to juggle chainsaws while riding a unicycle. You know it's going to be something. So buckle up, we're going in. FOXO is the healthcare services and technology business. They're trying to make it in epigenetics diagnostics, run a rural hospital, and dabble in mental and behavioral health. Sounds like a lot, right? As of the end of last year, they have a working capital deficit. That means they owe more in the short term than they have readily available. The amount they are short, almost $30 million. Their net loss for the year, the actual money they lost after everything was said and done, totaled almost $13.5 million. Ouch. That makes last year look good. They lost almost $30 million back then. I'd say they are losing money and fast. The company divides itself into two main parts. First, we have healthcare, which makes money from regular hospital services, as well as treating addictions. The other division is called Labs and Life. Here, they're trying to pioneer the use of our DNA to assess long-term health and wellness. They had this idea of using that to get into the life insurance world. They even started their own life insurance company. As we will see later, that didn't last. One of their big moves last year was buying Renova Community Health, or RCH. RCH runs a small rural hospital in Tennessee. FOXO is hoping this hospital will be a good base for them in the healthcare world. They also purchased Myrtle Recovery Centers, which specializes in substance abuse treatment. This is how FOXO got into the mental and behavioral health business. They want to combine this with the hospital and open more facilities like this. Now let's talk about their labs division. They think there's a big opportunity to sell health and wellness tests directly to consumers. They are also creating software for scientists to analyze DNA. They've been cutting back on expenses and selling off assets to focus on these areas. To protect their intellectual property, their plan is to patent all their creations. They've got some patents pending for their machine learning tech. If all goes well, this could give them a big edge in the health and wellness testing market. Here is something important to pay attention to. FOXO is carrying a lot of debt and most of it is currently in default. This severely limits the ways the company can operate. This is not a good sign. Here is something that raises eyebrows. It seems that the more shares are forfeited by the company's top managers, the more the company saves in expenses. It can give managers incentives that aren't aligned with shareholders. And speaking of being a healthcare business, they've got the same fears as everyone else. Mainly regulatory challenges in that landscape. Any changes to the Affordable Care Act or ACA or other healthcare laws could really mess with their business. The company admits that they are subject to all kind of federal and state laws related to healthcare billing, the kickback statute, and other shady things. If they fail to comply with these laws or regulations, they could face significant fines, penalties, and even be excluded from Medicare and Medicaid programs. As a recovery center, they also bring some unique concerns. An increase in health insurance premiums or co-payments might cause individuals to not seek medical attention, reducing demand for FOXO's addiction treatment programs. In other words, if average folks struggle to pay for health insurance, FOXO's profits might take a hit. Also, the testing market for at-home health analysis is becoming more crowded. They have a lot of competition. To summarize all that, there are external risks that will directly impact their profitability. They'll need to comply with an increasing number of rules, and they'll need to fight to get clients. And on top of all that, the company admits that adverse results in lawsuits could have a material adverse effect on their business and financial condition. Let's pause on the risks for a bit and talk about what they have done to try to solve these problems. Tap in 2023, they did a reverse stock split. Basically, they took every 10 shares of stock and turned it into one. It doesn't magically make the company worth more, it just reduces the number of shares out there and is usually done to inflate the price to avoid what's known as a penny stock. Remember how I said they got into the mental health and small hospital business? Here's how Pick cut that they entered into something called a stock exchange agreement, which sounds fancy, but just means they use their own stock to buy other companies. This is called equity financing, which means they're not using money, they are using shares. Using shares is a great idea if you have limited cash. Speaking of cash, this part isn't too comforting. To try and secure more capital, they entered into an agreement with Clearthink, but they haven't been able to actually use it yet. Should the financing FOXO requires be unavailable when we require it, the consequences could be a material adverse effect on our business, operating results, financial condition, and prospects. In other words, they might not be able to access it when they need it. The company admits that they may not be able to maintain effective internal control over their financial reporting in the future. That means their financial reporting could become inaccurate and they won't be able to meet their various obligations. Let's take a look at the financial statements and see what the numbers can tell us about where FOXO stands. Looking at the balance sheets under assets, we can see ops receivable net. As a reminder, those are invoices the company has sent but hasn't been paid yet. We don't see anything for the prior year. It seems a good part of their operations are Medicare and Medicaid payments. Those programs often try to reduce how much they reimburse companies. They have a great deal of debt which contains restrictive covenants. In plain English, because they have so much debt, it makes it difficult for FOXO to operate. This creates a viscous cycle where they need more and more money to simply stay still. Not a great recipe for success. The company makes a note that its compliance program is still being developed and that they have limited resources to ensure they meet regulations. It sounds like they are spread too thin. To finish off, a key risk for them is that if they are unable to protect their proprietary methods of identifying epigenetics, their brands would lose value. They may be unable to obtain sufficiently broad intellectual property protection, or they may lose our intellectual property protection, or they may lose our intellectual property protection. For a lot of their business model to now that we've decoded the report, here's what I think. I'm going to stay far away from this company. They're trying to grow and diversify into a very difficult marketplace, and it's apparent they have a lot of problems with debt, regulation, and competition. Also troubling is how limited their cash resources are, which is something the company freely admits as they kick this can down the road. If the business fundamentals for the core operations improve, that might be something to look at down the road, but until that happens, I have a very bearish position on this company. Thanks for watching Corporate Decoder. If you found this breakdown useful, don't forget to like, comment, and subscribe for more insights into the world of corporate filings. What companies or filings should I break down next? Let me know below.